Welcome. Welcome, everyone. I'm Angelo Robles, and welcome to At Family Office and Family Office TV. And for my members, greatly appreciated SFO continuity. Today, why and how family offices should own and store gold. And I promise you, the majority of you are not doing it the optimal way that you should. So, most family offices own some gold, but I think they're doing it wrong. Gold is an essential asset more so than ever in today's world. And apparently, our central banks around the world agree. But the way you own it and store it could make or break its role, I would describe as a true hedge. So, in today's discussion, you'll discover the powerful story behind Swiss based Von GREYERZ, the family run business that redefines gold ownership with the world's largest private nuclear proof vault outside of the banking system. So, hopefully, now it's time to learn how to protect your wealth and gold in the right way. This is more than just owning gold, it's about protecting your family legacy in the face of rising global risk. Today, we're joined by Johnny Haycock. He's a partner at Van GREYERZ. And Johnny has a very intriguing background. We won't hold it against him, but a barrister in London who enjoyed a 27-year career in the city before joining Van GREYERZ to lead their family office department. His career, other than being a barrister, also took him to incredible, iconic institutions that we know all too well, like Salomon Brothers in 1997. Who doesn't read Liar's Poker, John Merriweather, Michael Lewis, all those cool people. One of those two I met. I'll have to let you wonder who that would be. Followed by 23 years at Morgan Stanley, where he advised hedge funds and institutional clients and served in the European Equity Underwriting Committee. During his tenure there, Johnny also became a trusted advisor to ultra high net worth and family offices. He now brings over 2 decades of experience to Van GREYERZ. Johnny, after that buildup, welcome to the show.
It's a pleasure to be here, Angelo. Thank you for having me. I wish I was as cool as Michael Lewis, but I'm sadly not.
Well, you got kind of that British James Bond vibe to you, so it's all good. I don't see the pocket square there, Johnny. Come on. What's wrong? What happened to the great Savile Row? Well, this is the first time I've done a dedicated program, dedicated meaning specifically to gold. It comes up in practically all of my economic and sometimes investment discussions. But I think it's been about a year and a half since I had Rick Rule on back in the day when he was at Sprott, dedicated to gold. So you are up next, and here we go. With central banks accumulating gold reserves at unprecedented levels, what signals are they responding to, and how should family offices interpret that behavior for their own portfolios?
Yeah, look, it's good. It's a good question, and firstly, I'm honored to be stepping up next after Rick Rule, who's a legend of the gold industry. But look, to be clear, Angelo, I just want to correct you on one point there. You talked about all central banks accumulating gold. That's not quite correct. Not all central banks are accumulating gold reserves today. Generally speaking, it's the Eastern central banks. And this is such an important point that I want to make to you and the listeners, that the theme throughout our interview today is about the power moving from west to east. Okay, so today what we see, and you got to look at the official gold holdings, and that is that it is the Eastern central banks that are acquiring gold at a very, very fast rate today. So China, Russia, India, Brazil, Turkey. Okay, just to name a few. I mean, there are some in the West, to be clear, right? But the majority of the central banks that are buying gold today are Eastern central banks. So power from west to east. And I think the context is really, really important here. So if you go back to 1980, 74% of central banks' balance sheets globally was in gold. 74%. Today, that number is 20%. So that is a massive decline, okay, in the percentage allocation of central banks to gold. 74% in 1980, 20% today. As you say, at a time where risks are rising pretty dramatically, and arguably, and we'll get into this, that risks haven't been this high, arguably, since the Second World War.
Agreed.
So the signal that I think family offices need to be responding to is the fact that the emperor has no clothes. Okay? The emperor is being proven to have no clothes. And I'm talking about the US. And the Eastern central banks have worked this out. And there are two issues here. One, unsustainable debt, and we can get into that in the numbers. And it's secondly, the sanctions, okay, on Russia post the Ukraine invasion. And what that shows is that the US basically is prepared to steal anyone's money. So central banks, understandably, Eastern central banks are understandably replacing dollar assets with gold. And it's at this point, I think, Angelo, it's worth just remembering what the great historian Niall Ferguson said recently. He said that history shows that when any great nation finds itself in a situation where the interest on its debt is higher than its defense spending, then it doesn't stay great for very long. And that is the situation where the US is today. And I think that the bond market is working this out. I mean, who would have thought, if you'd come down from Mars and someone had said to you, look, you're going to have interest rates rising, gold is going to still do really well, because we all know that gold typically does better when interest rates are falling. Okay, it makes sense. But that hasn't happened this time. And so we have to ask ourselves the question, well, why is that? And I think the reason for that is that the bond market has worked out that the US has a real problem, that this debt, the fiscal deficit, 7% of GDP, 125% debt to GDP ratio, that this is becoming unsustainable. And I think, again, Eastern central banks can see it. They haven't had enough gold in their reserves. That is why they are buying it hard, whilst the West in the main still are not. Now, you could say to me, Angelo, you could say, yeah, Johnny, but come on, the debts have been high for a very, very long time. So what's different? What's different this time? And look, the truth is, I cannot tell you when this debt time bomb is going to blow. Nobody can. David Einhorn said earlier this year in an interview, he said, look, debts don't matter until they do. Until they do. And when they do, you've got to be protected. And that's the message that's got to come out from, hopefully, from this interview. And it's very interesting that the Eastern central banks are arming themselves. They're protecting themselves by getting away from the dollar, which is obviously devaluing at a rate of knots, fallen 98%, versus gold since 1971, of course. And so family offices, I think, listening, need to heed this clear signal and reassess the scale of their US asset allocations, whether that's in public equities, whether it's in US treasuries, private equity, given the leverage in the system. And frankly, should just be listening a little bit to what Eastern central banks are saying and just follow what they're doing. Because at the moment, and you alluded to at the start, that most simply are not. And maybe just to finish off on this question, maybe the real signal that people should be listening to is Taylor Swift.
You'll have to explain this one, Johnny.
Because I see that after the debate last night, that she's now backing Harris. Well,
Well, I think that was to be expected.
I haven't seen any policy from Harris that's addressing the fiscal deficit. So if Taylor is now going to swing the US electorate to backing Harris for the White House later this year, then good luck to getting those fiscal deficits down and the debts down, because I don't see the policy.
Well, wow, Johnny, you give me so much there to think about and follow up on, and some of it is going to be addressed in upcoming questions that I have. But sure, probably not the time to discuss the debate in detail today. But in the next week, audience, I look to do a debate about the debate and being fair to both perspectives. And by the way, I don't think neither of them have what I would define as a way that we need to address our deficit. Things that Johnny brought up, the interest on the deficit is well above 1 trillion, more than our defense budget. And if you extrapolate that to how things could play out in the years to come, it is simply unsustainable. And we don't have the revenues, the tax revenues, to be able to afford it. Now, that could lead to a discussion on GDP. That could lead to potentially discussion about enhancement with energy and or AI and robotics, but we'll save that discussion, because who thought I would mention robotics in a discussion about gold? But you do never know. You did say a couple of interesting things there, and this is coming from someone who has a private masterclass that I host called Sovereign Risk and Disaster Preparedness for Billionaires and Family Offices. You're correct. No matter how American we are, the fact of the issue of seizing Russian assets should be of grave concern, because that's going to trend down a very, very negative area. So when you look at gold, and depending on its storage, as having no counterparty risk, that does become interesting in this perspective. All topics that, as we progress in our conversation, we'll dive into. I will make a comment and then ask a question. The comment is going to be, for those here in America and in the West, today is a special day. It's 9/11. It means something very important to myself and many Americans, as we were effectively attacked on this soil and many thousands of people died. And that's very sad. I worked with someone whose husband died in the attacks, and back at that time, going back to 2001. And it's a horrific thing to happen to the family. So God bless America. Certainly, God bless those families that were impacted by that event, as I think really all Americans were. And today is a day, sadly, for mourning and not forgetting. So on that moment, I will give a 1-second moment of silence, and then we'll move on to our next question. Johnny, my next question relates to what you built up to, and that is, we know about Bretton Woods, we know about the dollar becoming the world reserve currency, 1944, but whoa, what really impacts our discussion today is the year of 1971 and President Nixon. And that is effectively coming off the gold standard that would then become the norm for other countries. And our currency is not backed by anything tangible. Now, I know there are going to be people that are going to say, well, look at our military, look at our planes, our boats, our naval force. I hear you, brother and sister, but this is a little different. The actual currency itself used to be backed by gold that had limited, you can't just print it on limited or mine it. Maybe it's what, a 2% a year. So henceforth, what was that historic day in that year of 1971 and the impact it had, looking now at what, 50 plus years later, on monetary policy, on fiscal responsibility, and to some degree, the mess that we're in now?
Yeah, look, I mean, look, 1971 is a key moment, right? You know, that Nixon, when he collapsed the gold standard, what he said was that, don't worry about it, guys, right? Because the dollar is going to remain strong. That was a lie. The dollar has fallen 98% versus gold since 1971. Okay. So it's had a massive implications, which all leads into this discussion. But if you think about what happened back then and why did he do it, right? You know, you had the Vietnam War. Debts were increasing. The dollar was being attacked. You know, Nixon had to do something, right? He had to stop gold from being exchanged for dollars. And obviously, when he did that, he had to make this promise that it was going to remain strong, which we know was wrong. But doesn't that all sound quite familiar to where we are today, right? You got wars, you got a weakening dollar. We've just talked about Eastern central banks that are repatriating assets away from the US, away from the dollar into gold, something that is a store of value over many, many centuries, millennia. And so the reality is that Nixon had to sacrifice the currency to save the broken system. And it's kind of interesting that we're seeing a similar narrative today. You know, someone I respect enormously, Russell Napier, just a great market commentator, and his theories on financial repression are very well understood. But for anyone that doesn't follow him closely, you know, when he thinks about financial repression and inflation, he basically says that, you know, inflation is stealing money from old people slowly, right? That's basically what it is. It's the practice of trying to keep borrowing rates, you know, below inflation rates, okay, in order to, you know, gradually inflate the debt away. And I see this parallel today completely. So look, back to your point, 1971 and what Nixon did is absolutely critical. It's had huge ramifications for currency markets, okay, frankly, for all markets. And you can see now that having had this decline in the allocation to gold from central banks since 1980, having decreased from 74% to 20% today, central banks have woken up and smelled the coffin thinking, uh-oh, we've got a problem here, right? And that's why that 20% allocation to gold is going back up. And that's why gold has been strong at a time of rising interest rates. And again, we can talk about a little bit more about this and monetary policy, but the reality is that currency is only going to carry on weakening. And that's the position that we're in today.
Excellent. And I believe, although we covered a part of it, I think my next question is still important to ask, arguably with a little bit of a twist as we progress. How do you view the relationship between fiat currencies, which are backed by nothing, and effectively debasement, and gold's trajectory over the next decade, particular in economies that are highly levered and reliant on aggressive monetary policies?
Yeah. Look, I think the first thing I'd say is we shouldn't be assessing gold over 10 years. It needs to be assessed over 100 years. Okay, it's got to be viewed over a much, much longer time horizon. And history will tell you that, you know, history will inform us about what the future will look like. But the problem today, Angelo, is that a lot of people just don't study history closely enough. And it's just much easier and frankly more fun to extrapolate the good times that we see today in stock markets and to assume a continuation of that than actually think about, well, what is the maths telling us? And, you know, what is this debasement of currency that we are seeing shows us. And unfortunately, the maths of today and the facts about debt and inflation mean that, you know, history may not repeat itself, but it certainly rhymes. Mm-hmm. And what history shows us, it was Mark Twain that said that, wasn't it? what history shows us, and Voltaire said this, of course, in 1728, that currencies all return to their intrinsic value, which is zero. Think about it, right? Yeah. No currency anywhere in the world over the last 500 years has survived, right? It hasn't. I mean, just take the last 100 years, okay? And this is, you know, when I speak to family offices about this subject, I try to get it to the real world and make it easy to understand. And the best way that I get it clear in my own head is to think about it this way. In 1920, gold traded at $20 an ounce. So in 1920, 250 ounces of gold was worth $5,000. And in 1920, $5,000 bought you a 4-bedroom family home in Middle America, okay? Roll forward to today. $5,000 will barely pay the insurance on the home for a year, let alone buy a family house in America.
And by the way, my audience would understand this. That would be about the monthly insurance bill in California.
Okay. But if you held on to your 250 ounces of gold, that's what, $625,000 today. That buys you pretty much a 4-bedroom family home in Middle America. May not be in LA or Malibu, but in Middle America, that'll buy you a family home. So to me, that sums it all up. And I don't know whether this is myth or not, but you know, they say that, you know, in Roman times, 1 ounce of gold, you know, bought you a toga. Well, they say, well, maybe 1 ounce of gold will buy you a Savile Row suit. Well, looking at your suit, Angelo, I think you probably need 1.5 ounces of gold. But
maybe 2, actually, Johnny. Come on.
you get my point that this just being this. That's kind of all you need to know about currency debasement. And then you come back to the point about where we are with the debts. What does that mean for the dollar? We've got wars going on. They've got to be funded, et cetera, et cetera, et cetera. And then you talk about, well, what does it mean about levered economies? And I think this is fascinating, right? Not just moving away from America for a second. Look, America basically needs to bring down interest rates. Okay, in order to help corporate America that just has too much debt. Let's see what that does to inflation and whether that's going to be sustainable or not. My personal view is that I think stagflation is what's around the corner, but we may get interest rate cuts first, and let's see what that happens. But just take the UK example and the famous very, very short Truss government in 2022 and the famous budget with Kwasi Kwarteng. And in that budget, they announced these unfunded tax cuts. Now, we're all for growth, right? And you've got to get taxes down in order to stimulate growth. And the UK is a separate subject. We're terribly worried here about what's going to happen here with the budget on October the 30th. But just bear with me for a second. So in autumn 2022, the Conservative government, as it then was, announced these unfunded tax cuts. And look what happened to the bond market, right? Or the gilt market here in the UK. The bond market said, you guys can't afford this, right? You can't afford it. And the bond market sold off spectacularly quickly, okay? And almost overnight, Angelo, the pension fund industry in the UK became insolvent with asset liability mismatches. Almost overnight. Liz Truss lasted, what did she last? Less than 2 months or something. I forget what it was. One of the shortest prime minister reigns in history. But this is a really interesting example about how the bond market will control, where interest rates are, okay, for mortgage holders in a levered economy where you simply can't afford to do that. And I think that is a classic example and a lesson for levered economies and how central banks can lose control of interest rates And I look, we haven't seen it yet with the US. We haven't seen it yet. But back to this point about how, rates, bond yields have been rising at a time the gold price has been rising at a time of interest rates rising in the US. And that's because I think the market is smelling something. The market is smelling that these debts are just unsustainable.
And Johnny, given the longstanding debate over gold's role as inflation or deflation hedge, how do you see gold performing over a prolonged stagflation scenario, or even during what unfortunately could be rapid economic contraction?
Okay, so let's define stagflation. Stagflation is high inflation, it's high unemployment, and it's stagnant demand. And frankly, it's the worst scenario for risk assets. And I think, again, we've got to look back in history to the 1970s, where that was the last time that we had a proper stagflationary environment. Now, during that 1970s stagflationary period, gold vastly outperformed the stock market and became one of the best performing asset classes of the decade. And after the US abandoned the gold standard in 1971, gold prices rose from $35 an ounce to around $195 an ounce by 1974. And despite some volatility, they continued climbing to a peak of, $850 an ounce in January 1980, right? And I listened to your Rick Rule interview, and Rick Rule made the point that in his career he'd seen two mega bull markets in gold, and he talked about this one. That was a very, very long, protracted bull market in gold. Okay, but it was the stagflationary 70s. Now, in contrast, the stock market, and let's take the S&P 500, experienced massive volatility, very poor returns throughout the decade, particularly during the 1973, 1974 bear market. Mm-hmm. And the S&P lost about half its value. I think it was actually worse in the UK. And so when adjusted for inflation, gold provided substantial real returns, while the stock market's real returns were often negative due to the era's high inflation and poor economic growth. So I think that period, Angelo, underscores gold's role as a hedge against inflation, against economic instability, preserving wealth when traditional equities have struggled. So I think that is the perfect example of cementing gold as a safe haven asset at a time of economic turmoil.
That's a good point, Johnny, and you're not incorrect. And definitely those years in the mid 70s in the US and much around the Western world were very, very challenging. I probably could make the point that inflation hedges to be optimized appear to vary depending on various points in time. You'll argue the example that you gave earlier of 100 years ago a home, and I agree with you, over long protracted periods, gold has been, let's go with the verbiage, an inflation hedge. But I could look at, in shorter term horizons, the S&P 500, or AKA the stock market, farmland, oil, energy, as also being things I could shockingly maybe even name the dollar. So it does, which may relate to my next question, which will give you an opportunity to answer that. It does appear, and I don't mean to be a conspiracy theorist, but it does appear that the pricing of gold has been at times, my words, artificially suppressed by market mechanisms, whether we deem that to be the powers that be that influence derivative and future contracts Therefore, there are times I expected gold to perform even better, and it hasn't. Why?
I'm not a conspiracy theorist, Angela. Look, I think there's clear evidence there has been manipulation. I think there's clear evidence. I was actually looking the other day at something that the economist William White said back in 2005. Okay, now I forgive me my thoughts on dates. I might have got this wrong. Now, an eminent economist. He certainly worked at the BIS, the Bank of International Settlements,
Sure.
at one point. And I've actually, seen a quote from him that talked about, and I quote, joint efforts to influence asset prices, especially gold and foreign exchange, in circumstances that might be useful, close quotes. I mean, that's pretty clear to me, right? And the BIS is the central bank of central banks. Okay?
Absolutely. They are the central bank, central banker. And in that masterclass that I referenced, trust me, they get some love, although some people may call it hate. I'm very familiar with it.
I mean, and then of course there's, Mervyn King, former governor of the Bank of England. And he himself, again, I forget the speech, but he himself admitted to joint coordination of selling gold in order to support currencies. Now, you've got to think about this. Well, why? Well, I think the reason why governments don't want the gold price to go up is because it reveals the mismanagement of the economy.
Mm-hmm.
Yeah, it's a mirror image of a mismanaged economy if the gold price is doing well and the currency is weakening. One other thing. Now, this is a little bit left field. So I'd say don't quote me, but I know there are people listening here. But there's been some pretty odd trading over the years, right? So we've seen, those that follow the gold markets very, very closely will kind of know this. It hasn't been recent, but some time ago, there were some very, very large sales of gold via futures contracts just after midnight European time in very, very liquid markets. Who's doing that? I don't know, but pretty odd trading. And the suspicion is that was some manipulation. I'll say no more on that.
In light of, we kind of covered it, but I think it's important to revisit. In light of increasing geopolitical instability and the rise of a multipolar, it's not just the US. I don't think it's even quite the US and China. We see the BRICS, we see Saudi Arabia and their growing influence and impact. And although part of the BRICS, even the rise of India, especially as the decades progress, and other parts of the world. Could I still look at gold as being the same safe haven asset that it's been, not just for the 100 years that you referenced, given the US home example, but really thousands of years? Do you think that will continue?
I see absolutely no reason why not. I think that you talk about the BRICS. What's fascinating about the BRICS, and again, this is back to the Eastern central banks buying gold. This movement of the shift of power from west to east. And here's by the way, on this point, here's a really interesting stat again from Niall Ferguson. In the year 2000, the US had twice the manufacturing value add of China. 24 years later, China has twice the manufacturing value add of the US.
That's a shockingly short amount of time for that switch to occur.
It's an absolutely amazingly short space of time, and I think that, you know, again on the BRICS, you know, we have to just think about supply and demand of gold. We have to think about the impact that this move is happening. Again, remember, 74% of global central banks' balance sheets to gold, now 20. That's only going one way. Is it going to go to 30, 40, 50? Why not? Who knows, right? But it's going to have a big impact. And the BRICS, because they're so resource rich, right? Russia, for instance, got $85 trillion of natural resources. You know, if they carry on, you know, buying gold, and you know, there has been discussion about, you know, the BRIC countries backing their currencies with commodities, right, including gold. You know, we need to think about this. You know, what is that going to mean? And given all the natural resources that they've got, whereas the West, well, what have we got? We've got a lot of debt, and our assets are basically financial. And then it brings you on to, okay, so let's just walk this through. If the BRIC countries just carry on doing what they are doing, and we can debate what would make them stop, but it's hard to see at the moment. You've got to look at supply and demand. So there have been 200,000 tons of gold produced ever. And there are 3,000 tons of gold, new supply every year.
Which is what, about 2%?
Yeah, 1.5%.
Right.
Okay. And so, you know, if this were to carry on, and we can see that this 1.5% is being very easily mopped up by ordinary demand. And so we have to think about, well, okay, is this going to be inflationary if, for instance, this carries on, or you know, maybe their currencies are backed by commodities? I would say it's going to be very, very inflationary, right? And that leads on to the question: well, what happens? What happens after that? Because there just isn't the supply to satisfy that level of demand.
And that goes back to supply and demand, specifically when a given market infrastructure, which leads to an increase in price. And then I think we have to say to ourselves, okay, well, if that means that interest rates are going to rise further, and yet we've got this unsustainable debt burden that we can barely service, then what's going to be the impact on monetary policy on that? Well, surely what it's going to mean is going to be, you could get a proper rout in the bond market. You know, faith in the US declines further in US assets. And that brings back more quantitative easing. And we keep hearing this phrase, you know, QE to infinity. But I mean, if this were to happen, the BRIC countries keep on buying gold and back their currencies with gold or commodities, then that can lead to further QE, more buying of bonds. And what does that do? It devalues the dollar even further. And then take it to the final point. Well, what's that going to do to gold? It's only going to go up. And Angelo, this is before the institutions have woken up to allocating enough to the asset class, right? I mean, I spent 27 years in the City of London, 23 years at Morgan Stanley, talking to institutions. I mean, they are just not in gold. I mean, I'm generalizing, but they just don't own it. I've been to big wealth managers here in London to talk to them this year about gold.
one said to me, "Look, we sold all our gold in 2014. You know, we don't have a solution for this." That's where we are. So again, come back to that supply demand point. If that demand is going to be satisfied, it can only be satisfied at much, much higher prices, and that's before institutions,
Exactly.
family offices have increased their allocations to gold. And then, you know, maybe now's the time to talk about under ownership, but I'll let you.
Well, we are getting into that shortly. So there are some questions and comments that came in. To the one that noted, actually on your subject, will Johnny be getting to on von GREYERZ in terms of how the storage aspect works and potentially what are the cost of that? The answer is yes, but that's going to be more towards the end of the interview. If
Sure.
any of you have to go, no worries. It's being recorded and happy to share a copy of the recording, which also relates to a comment and quasi question from Brian. Brian, one, thank you for your kind comment. Brian is a financial advisor, maybe an MFO, who's enjoying your commentary, Johnny, and basically notes he would like to share it with part of his network. So that does cue me up pretty well. It's hard for me to copy and paste from comments in a platform, and I don't want to forget. I'm not 27 years old anymore, although I do take a lot of vitamins and work out, so hopefully I won't forget. But to be really assured, my email, send me an email, is angelo@angelorobles.com. And I'll make it really easy, which all of you should be doing. Now, not all of my content makes it up there, but go to @FamilyOffice on YouTube or @FamilyOffice TV on YouTube. They're both mine. And within probably a couple of days after this will be produced with a little more graphical elements and is up for the world, you just really have to go there and subscribe and you'll find it. Otherwise, you'll email me. So hate to give, not that I'm ever afraid to, a little bit of an infomercial from my perspective, but there's a little bit of one of them. And if you really want interactivity and access, you really have to join my private club at SFO Continuity, which, and we'll bring this up again, but if you would like to meet Johnny, I know absolutely how that could happen because myself and a wonderful gentleman who is my family office expert and liaison in Europe for my journeys in Europe that I enjoy so much is coming with Johnny to the US, New York, and I will be hosting a breakfast. It is Thursday, October 10th. It's a breakfast, so if you're a member, take that down. If you're a qualifying family or single family office or a founder or partner in an MFO, you really should be joining. But if you would like to understand a little bit of who we are and what we do, you may want to come into New York just for that, because that will be a multi-hour breakfast, very deep. You can meet Johnny personally, and I'll be in New York all day, and maybe we have a chance to meet other families, talk peer-to-peer on investing and other subjects. So again, Thursday, October 10th, come to New York. All good. Johnny, on that note, before I get to about 3 to 4 more questions specifically on some of the issues more specific to gold, I do think it's important to take a little bit of a step back and talk a little bit about the uniqueness of von GREYERZ, a little bit about the history of the firm, its culture, its family values, the fact that it is a family firm that you're gainfully employed in, and tell us a little bit about Switzerland and how it all interplays.
Well, look, thanks for the opportunity for allowing me to talk about von GREYERZ specifically. I mean, I'd actually like you to feel very sorry for me, because I think that I will go down as having the longest interview process in history. It lasted 25 years before I was actually offered the job of joining the family business. But no, joking aside, my father-in-law is the founder of the business, Egon von GREYERZ, and he's a remarkable man, and he's had a remarkable career. And look, to be clear, you know, the intention was actually at the start never to build the business that he has done. But it is worth just talking about, well, how it came into being. Basically, keeping the long story short, in 1999, he was advising a friend of his who owned an e-commerce company. And this friend had a bid from an Asian buyer. And any listeners that were around in 1999, 2000 will, of course, remember the dot-com bubble and the subsequent crash. And this friend said to my father-in-law, who'd had a storied history in corporate life and in investing his own money, the friend said to Egon von GREYERZ, "Look, what should I do? I've got this bid on the table." And Egon leant across the table and said, "There's only one thing you need to do with this bid. You've got to bite their hand off. And we're going to fly to Hong Kong tomorrow and we're going to get cash for this business because you're getting offered a ridiculous multiple of sales. Of course, there were no profits in the business and you need to hit the bid now because these valuations are not going to last." Amazingly, they were able to secure that deal. The dot-com crash happened. Egon's friend was a very happy man. And he then said, "Okay, that's interesting. What do I do with the money?" And this is here we are on the anniversary of 9/11. And this is pre 9/11. Egon said, "Look, I'm worried about derivative risk in the financial system. I'm worried about geopolitical risk rising. I see that gold is trading at $250 an ounce. This is sort of 2000, 2001. I think what you need to do is you need to buy as much gold as you can." Gordon Brown, of course, had just sold half of the Bank of England's gold at the lows. This is an amazing opportunity. And that's exactly what the friend did. He bought at that price. 9/11 then happened. And Egon and his family, and obviously I knew the family at that point. I married the middle daughter in 2002. So I saw all this happening. I was there when Egon said, "Look, this really bothers me. We need to get out of the UK. This is a problem. We need to go to a safer jurisdiction. We're going to Switzerland." And they had a history of holidaying in Zermatt. They moved to Zermatt, and Egon put all his money into gold himself, aligned himself with his friend at $250 an ounce, and it's never sold. And here we are at 2,500. And other friends and acquaintances saw what he was doing, and gold started to move, thought it was interesting. And people obviously after 9/11 were worried about risk a lot more. And they said, "Look, would you like to help us protect our wealth?" And he said, "Look, okay, sure. Look, got some money, invested for friends and family, and invested in gold again." And that was the genesis of this business. It was never intended, to be a big business that it is today. And here we are today. And this, of course, was pre-Lehman, before, this was before the time when counterparty risk was actually a thing. But Egon's vision was pre-Lehman that you've got to own physical gold for protection. It's a proven store of value over thousands of years, but you've got to own it outside of the banking system. Because what if the bank does go bust? I mean, here we are sitting today, Angelo, and we've almost forgotten that Credit Suisse went bust last year.
A Swiss bank, a giant one at that.
I mean, you couldn't make it up. And I remember sitting on the trading floor at Morgan Stanley in 2008 and coming home to my wife, and the share price was going down 20% every single day. And it was very clear that we were going bust on the Monday. We were one of the last to go before TARP came in. It was Morgan Stanley on the Monday and Goldman on the Tuesday. And then, of course, we got saved on the Sunday. Warren Buffett came in with Goldman. And the reality is, I remember sitting on that trading floor when clients of mine were on the phone saying, "Johnny, there's only one thing you got to do for me today. You got to get all my money out of Morgan Stanley and you got to give it to Credit Suisse."
Who would have thought?
You can't make it up. And who would have thought just a few years ago that Credit Suisse would go bust? But Egon had this vision that if you understand gold, which clearly he does, he's an economic historian, you've got to eliminate all counterparty risk. So you've got to hold physical gold outside the banking system. The only legal claim to that gold should be in the client's name, not in von GREYERZ, in the client's name, with your own personal serial numbers, with your vault receipt,
Mhm.
in the largest and most secure private vault in the world. And that sits in the Swiss Alps.
And is that area, I believe, from my journeys, Johnny, is that known as the Gotthard region?
No comment. If you become a client, Angelo, I'll take you round it.
Okay. I look forward to that day.
But no, joking aside, look, it's there's no advertising here. Obviously, our clients know it because they can go there and look at their gold themselves, and people speculate where it is. But it's an unbelievable facility. I mean, it's James Bond, 9 security zones, the 10th security zone, the King's Chamber to go in and where your gold is stored. It's absolutely phenomenal. But this key point about why gold, which we've discussed in this entire interview, and then how gold, if you're going to own it, it's got to be physical outside the banking system with the legal only with yourself. So roll forward today in Von GREYERZ, we're probably now, look, we have clients in over about 90 countries around the world, all 4 corners of the globe, and we have hundreds of clients, and it's a wonderful business. And then the final point to say is that, look, given my 27 years experience in the mainstream world at Morgan Stanley and Salomon, and given what we've discussed, and maybe now's a good time to come on to the sort of the under ownership of the asset class in the mainstream world, my experience we thought could be quite useful for Von GREYERZ, where this is a business that was founded upon really by people that always understood gold. They were already gold converts. They understood the need to protect themselves. And so given that this business in classic traditional Swiss family values, this is for the long term, this is for my generation, this is for my children beyond me, and then their children, to align ourselves with our clients.
And related to that, Johnny, in terms of what are the critical risks, and I talk to my audience, my members, my consulting relationships all the time about owning physical gold. Do I think they should have some gold coins and arguably bars in their home in a secret location? Probably. Uh, but owning future contracts, owning ETFs, you're getting kind of the market exposure, but you're really owning gold as a hedge against risk, and it needs to be actual physical. So you answered the question, I suppose, in Von GREYERZ, in what they do in Switzerland, of all places, in a very secure, quote unquote, facility outside of the banking system for the reasons that you noted that I've been talking about for years. And maybe that's why some banks hate me. So talk a little bit more, I suppose you could say, if I want to buy a real amount of gold, do I want to have it stored outside the banking system? Maybe even more specifically, why Switzerland, and what counterparty risk, I guess not banking, do I have to be concerned about?
Well, look, as I just said, if you owned your gold in Credit Suisse a few years ago, you probably thought that's okay. As the share price kept going down, you were probably thinking, do I really want my gold in Credit Suisse? Who would have seen Silicon Valley Bank going bust? And look, it goes back to so much of what we've talked about what's happening in the world. When rates rise, things break.
Yeah.
And counterparty risk was just never a thing until Lehman. And then it became a thing. And then with the printing of money that we've talked about, and the incredible wealth creation since then, the reality is it was only when Credit Suisse went, Silicon Valley Bank went first, of course, didn't it? Over those few days, and there was this rippling effect, and it was like 2008 was happening all over again. And so, to your question, if you want to own gold, given the risks that we've talked about at length, why on earth would you own it in a bank? Think about it. You own it in that bank, and China invades Taiwan. The Middle East, terrible situation with the war, intensifies with Iran. NATO gets dragged in further with Russia and the Ukraine war. Or the debt time bomb just goes off. Would you be happy owning your gold in a bank, a levered business, when you can own it outside the banking system in your own name? And you're the only person that has access to it and a legal claim to it. So that's my point. And, that's why you've got to own it physically, because thousands of years, the history that we've talked about, it's the history that shows us that it's physical gold that is the form of wealth protection, the store of value. Gold ETFs, look, this is a long debate, but the reality is there's plenty of people out there that say that these gold ETFs just aren't physically backed by the gold.
Right.
There isn't the gold that physically backs it. And where's the gold? Sitting in a bank. So and we can talk about mining shares or whatever, but at the end of the day, the purest form of wealth protection and wealth preservation is physical gold outside the banking system with the best insurance, eliminating all counterparty risk. And that was Egon's vision.
Excellent. And for those of you that think that your stocks, your treasuries, your other, that you don't see, feel, and touch, they're effectively ledgered, you don't think there's anything from a governmental and banking perspective or a DTCC perspective that could go wrong there. I hope not. I'm going to be optimistic not, but this goes back to sovereign risk and disaster preparedness. Is it more work? Yes. Is it laborious? Yes. Is it going to feel good you're doing it? Not necessarily. For those of you that are concerned about your continuity, which is a reason why my private club is called SFO Continuity. Continuity over the generations. You hedge and you plan for these risks. You have the opportunity to see around corners, even if you're wrong. And maybe you are taking some chips off the table of capital that you could get in addition, but you're already rich. You want to maintain it through inflation. I get it, purchasing power, but this is a complex undertaking that is maybe a little harder than it may look from the outside looking in. But stay tuned. At least for my members, I'll have more content on that coming up in the coming months. Johnny, if gold were to reach $5,000 an ounce, what specific macroeconomic and geopolitical conditions would the world need to be for that to happen? I'm assuming pretty darn bad, but you gave some examples of where things are looking bad and getting worse. So those conditions could happen.
Look, I mentioned three of them just now, right?
Right.
China, Taiwan, Middle East escalation, and the Ukraine war. It could be another bank going bust, right? It could be something. It could be, central banks losing control of interest rates. Any number of things. I mean, look, I can't forecast that, but you talked about 5,000 in the next decade. I would say 2 to 3 years.
Right.
I mean, seriously, and again, perhaps now is the time to talk about the ownership point, right? I mean, if this momentum that we see, I think that we are still in the very, very early stages of a long multi-year bull market in gold. It is absolutely not too late. I mean, what Egon says to all the employees at von GREYERZ is, look, he says, look, I've been in this business for 25 years, but it's only just starting now. And I think that it could be any of those geopolitical risks, but on the ownership point, just before leaving Morgan Stanley and joining von GREYERZ, I wanted to do some homework. So I read 5 or 6 big family office reports from, the great and the good. Yeah, so Goldman Sachs, JP Morgan, UBS, KKR, BlackRock, and UBS. So 6 great institutions. And then I looked at the asset allocation that they saw within the family offices that they were surveying. They looked at the asset allocation models. Only one of those 6 reports even mentioned gold, and that was UBS, as you'd expect, right? A Swiss institution. Only one even mentioned it, which I just thought was incredible. Roll forward to today, and in anticipation of this interview, I read the Citibank report. Anyone can read it. This is the most up to date to the end of June of this year, and they surveyed 1,200 single family offices, and they show the asset allocation, and I was staggered to see that only 0.7% of that enormous pool of capital is allocated to commodities. That's all commodities. So think about that, right? So let's be generous and say that 0.5% is to gold. And that could be ETFs, probably, right? Or gold mining shares or whatever, let alone physical gold held outside the banking system. And that's why it's a long-winded answer to your question. 5,000? What about 15,000? Because there isn't the supply. Think about it. When was the last big mine find of gold? Back in the 90s. It's getting harder and harder to get this stuff out of the ground. And back to our point, only Eastern central banks are buying. So my point is that if this thing starts to move as we think it will, slowly but surely, family offices come in, pension funds, institutions, along with central banks, don't forget at 20%, it's going to go up. It's only going one way. It's not going down. It's only going up. It was 74% in 1980 of central banks' balance sheets in gold. 5,000, come on. That's within 2 to 3 years.
I mean, we kind of already covered it when I mentioned earlier. Besides gold, we could potentially look at things like oil, like farmland. I could argue stocks. We could talk about real estate. We could use the word quote unquote a hedge against inflation. Whether true or not, it depends on what point in time. If you go through the statistics over time, gold, I believe, has been the most consistent, as you noted. But we also spoke about counterparty risk and systemic risk. Real estate has limitations from that perspective. And even something like Bitcoin, which, yes, I'm an advocate for in a small percentage. But by the way, what happens when there's no electricity? I don't know. You're not going to be able to buy or sell it. I'll tell you that. So, yes, do I think families should consider it? And perhaps for some as an opportunity or a hedge, it deserves a modest place in the portfolio. Sure, we can make that argument. But I think when you look at what could go wrong from a systemic issue, from banking to government to this and that, when I look at gold, when I look at Switzerland, it just appears to be the perfect fit. I had on Mark Faber, the Swiss economist who lives now in Asia. And Mark is great. I'm interviewing him 11 o'clock my time. It's near midnight his time. He's got a cigarette. He's got a bottle of beer. He's literally drinking a bottle of beer. He got me excited. I grabbed my whiskey and I had a little, if you all don't mind. But it's Mark Faber after all. He actually stated, and maybe his opinion changed. Maybe it went up in the last year and a half. But he stated he doesn't know why family offices don't have 20% of their assets in gold. Now, I could argue from my perspective, that sounds a little too much for me, but you're mentioning it may be as little as under 1%. That is unacceptable. That is not working from the perspective of how the world is now, looking at history and what could go wrong. It needs to be greater than under 1%.
Look, 0.5% of world financial assets today are in gold. In the 60s, it was 5%.
Yep.
So just think about that, right? Just getting back to the mean of 2% is a quadrupling of demand that can only be satisfied by a lot higher prices. And look, I want to make this point really, really clear, right? You know, nothing goes up in a straight line, right? You know, I mean, gold is a lot less volatile than Bitcoin that you talk about clearly. And look, I personally think that they're entirely different asset classes. Bitcoin's been around 15 years. Gold's been around thousands of years. I think they are more complementary than anything else. But it's not one or other. But you just got to get your sizing right. I mean, all I would say with gold is, you know, I've read academic research suggesting that the right amount of gold within an asset allocation model is 19%. Certainly at Von GREYERZ, we've got hundreds of clients and a lot own more than 20% in gold, but we would say, look, 20% is probably the right number. However, I can totally understand why, you know, family offices say, look, you know, 10%, that's going to be my insurance. That's my insurance policy, 10%, and I'm going to own it the right way, okay? But what did I just say about where we are? You know, in the Citibank report, you know, we're 0.5%. Just only going from 0.5 to 3 could have a big impact on the price. But, you know, you pay as your money, you take your choice. Some people say 10, some people say 20, whatever. Look, for me, it would be 20%. Now, given the risk that I see in the world. Now, look, if Treasury yields get a 15%, we're going to have a separate conversation, right? You know,
of course,
we got to, you know, we got to, you know, go where the puck is going, not looking backwards, right? And if we get to a point where Treasuries are yielding 15%. Well, we'll have a separate conversation where you want to be selling your gold at 20,000 and buying treasuries, right? But that's probably for a decade from now. And just by the way, on your the hard assets point, this is another thing I observe as I do meetings. I just don't think people have enough hard assets. If we're in for a stagflationary environment that's looking more and more likely. But the problem is let's look at history. You know, oil in the last 3 recessions in 2002, 2008, 2020, COVID. I mean, you know, oil fell peak to trough 60%. Right? And clearly there are the variables there with what's going on in the Middle East. There could be an oil shock, and it's complicated, right? But it's highly, highly cyclical. Real estate, right? Look what happened with the subprime crisis. Look at the leverage in that market, you know, and that's where rates are today at 5. Well, what happens if rates go to 6, 7, 8? You know, we know what happens in that situation, right? Values fall a lot. So again, I think hard assets will do well in the environment that I see, but you've got to size it right. And real estate, I don't know so much about farmland, but certainly real estate and oil are completely different kettles of fish versus gold in terms of proper wealth preservation.
And Johnny, I believe my last question before we get to a close. In the context of gold mining investments, do you see gold miners providing a superior risk-adjusted return if you're looking at it strictly from a return perspective compared to physical gold? And should investors weigh operational risk against the potential outsized gains?
I think it's a very timely question. Because gold mining shares, as you know, have done terribly badly for many, many years versus the gold price. Okay. And I think, look, within the stock market, I can see why precious metals mining shares finally actually could do quite well relative to the S&P. Okay. I can certainly see money coming out of the Magnificent Seven. We don't need to get into the narrowness of that market and some of the valuations that we see, right? But you know, you can see why money might be coming out or could come out, certainly in the environment that we're talking about, out of some of these other parts of the market to come to a very, very unloved part of the stock market, which is the mining shares. Only yesterday, you saw that Anglo Gold Ashanti bought Sentiment at a 36% premium, right? Or put a bid in at a 36% premium. Mm-hmm. That may not be enough, but I wouldn't be surprised when you think about the all-in cash costs for a gold mining company today at $1,900 an ounce, 2,500, you know, on the screen today. There's some pretty nice margins there, and you know, I can see that. I can see more consolidation. The timing feels right for more consolidation in that market, but that is investing and speculating, I would suggest, versus proper wealth preservation, which is physical gold outside the banking system. They're different. Okay, let's think about how the stock market has evolved over the last, certainly in my 30-year career in the city. The rise of passive money versus active. Okay, I think I'm right in saying that over half of all money in the stock market now is passive money. What does that mean? It's great on the way up for the Magnificent Seven when that passive money just has to keep chasing it irrespective of the price. But what happens when the bear market comes and that passive money has to sell? It may be, and this would be my bet, it may be that precious metals mining shares outperform a falling stock market big time. Big time. But you got a lot of risk there, and it's a different investment to physical gold outside the banking system, which in our view is the only way really for wealth preservation for the longer term.
Excellent, Johnny. A comment came in, then a couple of questions. We'll make them a little quick. To Giovanni. Giovanni, it's in the statistics from cities, so maybe they have families that are just not really that allocated to commodities. Maybe that's what it is. Maybe they don't want to share some of the truth behind it. You're also Italian and international. Maybe a lot of the families they did were more US and they were different. But it's been my experience that physical ownership of gold and even broadly commodities is okay. Maybe for some it's not under 1%, but it's definitely not 5% for most families. It probably is somewhere rather low, and definitely could use looking at from the perspective, at least on gold, that Johnny gave. We do have to move along a little quickly, Johnny, but a couple of questions came in. One of them, what are the regulatory reporting consideration requirements for gold held with Von GREYERZ?
It absolutely depends, you know, where you are paying your taxes. It depends. So look, I'm not a tax specialist, so my straight bad answer to that is, depending on where you are paying your taxes and where you are domiciled, then you will need to, you know, look at what you need to disclose and what you don't need to disclose. My understanding, our view, and we have a lot of American clients, is that if you are investing as a private individual, then you do not need to be disclosing your gold if you held it in Switzerland as a private individual. My understanding, as an entity, then you do.
Got it. A couple of other questions. For a family at, say, 100 million AUM, starting to invest into gold, what would you recommend to start the process concretely? Why is newly refined, his words in parentheses, important?
Yeah. Well, look, the first thing I'd say is please get in touch with me, and look, we have the system to help you, obviously. Look, our view is, for someone that is buying gold for the first time, 70% of the world's gold is refined in Switzerland. We do not deal in second-hand gold bars. Okay, if you came to me and said, I'd like to buy some gold, we buy direct from the refinery. You get your however many ounces that you want, or however many dollars that you want. You get as many ounces for the dollars that you're prepared to allocate to the asset class, and then we will get your gold and store it in our vaults with your own personal serial numbers and vault receipt, eliminating all counterparty risk. You will only have the legal claim. But our absolute principle is we don't deal in secondhand bars. We only deal in freshly minted bars straight from the Swiss refineries.
Excellent. And in the essence of time, everyone, we are going to begin kind of a close. A couple of quick points. For those that are listening live, I am hosting a peer-to-peer breakfast with members and select investor family office guests. No one else, I'm sorry. Have room for one more special guest tomorrow. So that is Thursday, the 12th in New York City in Midtown. Again, it's another breakfast. Apparently, I love to get up early and do breakfast meetings, which of course I do. So if by chance you wanted to reach out, I think you all know how to do that. But again, it's Angelo at angelorobles.com. And the week after, a couple of weeks after tomorrow, apparently I like Thursday breakfasts in New York at the Harvard Club with the before mentioned Johnny at GREYERZ. We are gracious enough to be hosting him in a special breakfast. It's for my members first. If we have a couple of other spots for qualified guests, you could have the opportunity, one, to learn more about membership, but at least to reach out to me. Again, Angelo at angelorobles.com. And we look forward to making that an enjoyable experience. Where I've done these before, there are some people that fly in just for kind of effectively a 2-hour meeting. But again, I'm going to be in New York all day. Maybe it's an opportunity to meet some peers, for us to connect more personally. So feel free to reach out. Happy to connect with everyone. Johnny, I'm going to give you a chance to maybe say a final word. And for those that would like the opportunity of following up, how could they learn more?
Absolutely. Well, look, thank you so much, Angelo, for giving me this platform and a really interesting discussion. I hope that the listeners have enjoyed it too and perhaps learned something. Look, for any questions or any inquiries about von GREYERZ and what we do and how we can help you, please just email me. My email address is jh@vg.gold. I'll answer any questions. I answer every single email that I get. So please get in touch, and we'd love to talk to you about helping you protect your wealth.
Great. And specifically for my members, but you could always reach out to me. I'm happy to make the email intro as well. I believe that connecting the dots among my worldwide dream team and my travels around the world and what I do in a variety of different subjects, including this one, like ownership and direct ownership and storage of gold, and specifically in Switzerland, hey, you're meeting some of my Rolodex, and I'm happy to share. Everyone, I'm Angelo Robles. If you don't already, go to YouTube, subscribe to @FamilyOffice and @FamilyOffice TV. I have also a newer Apple and Spotify podcast, Angelo Robles Podcast, and even a Rumble account where I have some videos up. And more so in the future, each of those accounts are going to have something unique and different to them. They're free, so why not go and subscribe? It's my members. I opened up today a little more that get access to private invites to digital programs that are private, investment opportunities, including certain things I'm looking at and I'm investing in, private off the grid, as well as opportunities to interact with a lot of the guests that I happen to have on. And for me, not also my content, my proprietary writing, but the opportunity of, like I said a little while ago, connecting the dots. I took a look at it. It's going to be in one of my marketing materials coming up in the next week or so. But over the course of a year from being active since I really went extremely active with SFO Continuity, my private membership group, digital and in person, 100+ different events, 100+. And many of you know my digital programs today at about an hour and 25 minutes is actually probably kind of short. Some of you have been to some of my 2.5, 3, and 3 hour plus programs, arguably a little too long. But I do enjoy doing them. I learn so much. I hope you all enjoy them as well. Again, some of them are totally off the grid, only for members, only interactivity and asking questions or connectivity to the special guest we have on via my members only. Go to angelorobles.com and simply join, be a part of the founding members at SFO Continuity. We have incredible members, great peer-to-peer, and I am active hosting in-person programs. They're small, intimate, and boutique, and they're primarily focused around peer-to-peer on investing, geopolitics, economics, lots of different things that impact the world of the family office. So jump on board and join what we're doing. Johnny, it's been incredible. Thank you for being such a great guest. I loved to cover this subject. It's been too long, and I look forward to seeing you in a couple of weeks. And again, a final shout out to my friend and our friend in Europe as well, Alexander Galambos, who's an incredible family office liaison. I greatly appreciate him. So Alexander's awesome. Sometime in the winter, we'll have him back on the show as well. If you go back to last November, I believe we had him on for a brief appearance. On that note, again, thank you, audience. Thank you, Johnny, and look forward to seeing you, meeting you in person in a couple of more weeks.
Looking forward to it, Angelo. Thanks so much.
Pleasure.